If you've only been half paying attention to crypto, here's what you missed. Bitcoin just went on a historic run, then face-planted hard enough to wipe out over $1 trillion of value in a matter of weeks. No major scandal, no catastrophic hack, no single smoking gun. It just broke. Again. And that's exactly why I want to talk about it, because the story of this crash isn't about the price. It's about who is moving the price now, and why the people who used to be crypto's biggest critics have quietly become the ones steering the entire market. By the end of this video, you'll understand why the average investor is suddenly getting crushed, while the big institutions are treating crypto like an ATM during a recession. Over the last 3 weeks, Bitcoin, largely viewed as a barometer of the cryptocurrency trading market's health and value, had a historic run-up, followed by what could now be considered a crash. To build some context, on January 1st of 2024, Bitcoin's price was $94,000. This year alone saw Bitcoin hit a 52-week low of $74,000 in April, a 52-week high of $126,000 just 6 months later on October 6th, and now, as of this recording, it's trading around $87,000. Now, I've stayed away from covering the topic of crypto largely because it's hard for me not to sound like some kind of boomer. And before I did the research for this episode, I didn't really understand much of it. Crypto aficionados will probably say I still don't, and that's likely a fair critique. But I do think it's a bullshit asset, more akin to gambling, trading off of dopamine and vibes as much as anything resembling value. There are no fundamentals behind the price like there would be for a publicly traded company like Johnson & Johnson or Amazon, no metrics or measurements around market performance or customer satisfaction, or even corporate innovation driving the price. It's more religion than business. But instead of praying to a suspiciously Caucasian version of a Judean deity, the crypto diehards make offerings at the altar of Ethereum and Bitcoin. In some cases, they make offerings to such dignified machinations as Fartcoin. I did not make that up. Fartcoin. Now, of course, there are supporters of crypto who are currently trying to downvote this video as if it were Reddit and leaving nasty comments. I get it. You are true believers. Maybe you made a bunch of money because you were early in the market, or at least on the bottom of the last significant dip. Congratulations. And it's not just the crypto stands. There has been real wealth generated in this surprisingly massive market. What was once a dark web darling among Cheeto-fingered basement dwellers, crypto is now a big business for investment banks, hedge funds, and all manner of institutional investors. Once the big institutions realized there was money to be made, they jumped in with both feet. I hope you're enjoying the content, and if you are, please consider subscribing to the channel. Back to the episode. Crypto used to be an outlier, a pirate radio type movement, but now institutional investors have become the largest players in the space. Institutional trading represents as much as 60% of all crypto trading, up from around 20% just 5 years ago. In fact, when Bitcoin started being included in ETFs in January of 2024, expanding the average investor's exposure to crypto, Bitcoin's price jumped from $42,000 in December of 2023 to $103,000 by December of 2024. Now that crypto has been legitimized and made common by everyone from Deutsche Bank to Merrill Lynch, let's understand how we got here and what happens next. Because according to experts, between $22 and $24 trillion worth of trading volume moves through Bitcoin alone every year. I'll save you the history of crypto as it's complicated and mostly urban legend at this point. To be honest, its retelling sounds more like fable than historical record, but it is important to understand what it is and isn't. So according to Merriam-Webster, a cryptocurrency is a form of digital currency that exists only electronically, typically without a central issuing or regulating authority. Instead, it utilizes a decentralized system, most often blockchain technology, to record transactions and manage the creation of new units. Cryptocurrencies rely on cryptographic techniques to secure transactions, prevent counterfeiting, and ensure transfer authenticity. Put simply, cryptocurrency enables peer-to-peer digital payments or value transfers without intermediaries like banks, leveraging a distributed public ledger that is inherently secure and transparent. The most well-known example of cryptocurrency is Bitcoin, introduced in 2009, which pioneered this decentralized approach. So what is blockchain? Well, blockchain is a basic custodial technology that underpins most cryptocurrencies. It's what verifies the location and movement of crypto from one entity or wallet to another. And it creates an end-to-end historical record of that token from origin through current location. Think of it as the, quote, ledger for crypto. While crypto has always had fervent and vocal supporters, referencing the egalitarian, decentralized system and access benefits provided by these digital currencies, there remain questions about its practical application and intrinsic value. Part of the argument for crypto is its use as a currency, that it can and would be used to pay for things. Because it's not backed by any government treasuries, and given its decentralized nature, it should be an easier currency to use across countries. It doesn't require currency exchanges and fees associated with those exchanges, and should be more resilient to inflation or monetary policy. And while adoption has increased over time, it's still practically difficult to use it as you would credit cards or the US Treasury-backed dollar, for example. Try buying a gallon of milk with Ethereum at the grocery store and see how far you get. The value of that currency is tied to trading, not to a nation's economy, the underlying value of its currency, or even the guarantees of a central treasury backing it. So what your current cryptocurrency is worth varies minute to minute. It's pretty hard to accept digital currency as payment for goods and services when the price changes that much. And the data is proving this out. Analysts with investment banks are talking about adoption, citing a decline in crypto usage from 17% to 15% just this year. So it kind of stinks as a currency. Then there's the argument crypto is secure and traceable, and that would be true except for the rampant fraud and theft that takes place every year, including the investors that lost roughly $2.2 billion from crypto platform hacks and scams in just the first half of 2025, surpassing the total losses for all of 2024, or the victims of the $15 billion Prince Group pig butchering scam, or the $2.1 billion investors lost as part of the Binance hacks and scam. So not very secure. I know, the amount of loss is a drop in the bucket compared to the total cryptocurrency market value. But hackers don't skim off the top of all the accounts. They wipe out individual wallets and represent 100% loss for those specific victims. Blockchain technology underpins most cryptocurrencies and the exchanges that trade them. But blockchain transactions themselves don't contain personally identifiable information, instead using pseudonyms and wallets that can't be readily tied back to any individuals. That enables widespread use of cryptocurrencies to fund illegal activity and transactions. According to the website Chain Analysis, as much as $50 billion of cryptocurrency value was received by illicit actors. These crimes and illicit activities can include money laundering, ransomware and extortion, investment in romance scams. I mentioned the Prince pig butchering scam, which is a form of a romance scam. Darknet market transactions where crypto is widely used on drug web marketplaces to buy and sell drugs, weapons, counterfeit goods, and other illegal items using Bitcoin and privacy coins to facilitate transactions outside financial oversight. There are Ponzi and ICO scams, and this includes fraudulent initial coin offerings and Ponzi schemes which exploit investors by promising unrealistic returns, then disappearing with funds or collapsing under unsustainable business models. There's electricity theft for mining, there's hacking and theft, there's sanction evasions and terrorism financing, and now, potentially, political influence and amnesty deals being cut using cryptocurrencies or some exchange. Changpeng Zhao, the former CEO and founder of Binance, has financial ties to World Liberty Financial. If that name sounds familiar, it's the cryptocurrency company associated with the Trump family. So an anonymous cryptocurrency wallet received approximately $2 billion worth of World Liberty's US stablecoin between April 16th and 29th, 2025. This wallet is linked to Binance, which Zhao founded and led. Zhao pleaded guilty in 2023 to charges related to money laundering at Binance and stepped down as CEO, later receiving a pardon from President Donald Trump just a month ago amid these business transactions between Binance and World Liberty. But maybe the most coherent and consistent pro-cryptocurrency argument is that these digital currencies represent, quote, stored value, similar to gold or collectibles. Here's the problem with that. Crypto doesn't actually behave like traditional stores of value like gold or real estate. Unlike stores of value, crypto can be extremely volatile. A good store of value should preserve purchasing power reasonably and predictably over time. Cryptocurrencies like Bitcoin and Ethereum regularly swing 10 to 50% in short periods of time, which makes future purchasing power highly uncertain. That undercuts their use for savings, retirement planning, or even pricing long-term contracts. As I mentioned earlier, it has a weak linkage to the real economy. Traditional stores of value like productive equities, real estate, inflation-linked bonds, even fiat currencies under a credible central bank are tied to cash flows, tax capacity, or real assets. Most crypto tokens don't produce cash flows. Their price is driven largely by sentiment and speculative demand. They have a crisis-sensitive track record, and a robust store of value should perform reasonably in stress. Crypto has fallen sharply alongside speculative tech stocks and tightening liquidity, not acting stable at all. It's literally why stablecoins were created. I'd explain stablecoins, but I'm trying not to lose half my casual viewers here. Feel free to Google that in a few minutes. There are persistent regulatory and technological risks. We could see, and at some points have seen, regulatory bans, taxation changes, protocol bugs, attacks, all of which can materially impair a token's value. That's not the safety the average person wants in stored value. Remember NFTs? Those were supposed to represent stored value as well. So as a utility or stored value, it's kind of meh. So now that I've set the deck on the current state of crypto, let's get back to the headline. Over $1 trillion in value related to digital currencies has been wiped out in the last 6 weeks. How? Well, no one really knows, which is kind of the problem with this whole asset class. When the price and related value of these tokens is based on whatever price someone is willing to pay another person for that coin and has no utility worth beyond the speculation its value will increase, you get an untethered market that is subject more to vibes than rationale. So when the price runs up, no one really knows why. It just does. We are, however, starting to understand why the price goes down and maybe why it may stay lower, at least in the near future. Deutsche Bank recently released their analysis, which included a few important distinctions about why this crash may be different. Quote, unlike prior crashes, driven primarily by retail speculation, this year's downturn has occurred amid substantial institutional participation, policy developments, and global macro trends, end quote. Translation, those massive institutional investors are selling and driving down the price, and they are now 60% of the total crypto trading volume. Deutsche also mentioned the Tinkerbell effect. Quote, this recent crypto underperformance also resurfaces our Tinkerbell effect theory that Bitcoin's valuations depend partly on belief-driven adoption. During this correction, the Tinkerbell effect is prevalent as sentiment-driven selling has reinforced the price decline, end quote. Finance Bro translation number 2, crypto price and value are what they are because people believe that's what the price should be. They believe that crypto is this store of wealth. If or when that belief fades, the market loses the one thing that props up prices. Crypto markets are also highly leveraged now, meaning that many accounts use their tokens as collateral for their other trading accounts. This means when the rest of the stock market starts to sink or has a significant shock like the October 10th flash crash, when President Trump reignited his trade war with China, and that prompted a wave of panic selling, triggering automatic liquidations across the crypto market, the flash crash forced many investors to sell their holdings to meet margin calls. According to CNN, quote, that tends to have a snowball effect. The more Bitcoin falls, the more calls investors face from their brokerages, the more they have to sell their Bitcoin and other holdings to cover their positions. In a single day, the flash crash wiped out $19 billion worth of crypto, end quote. So crypto, or at least the name brand currencies, have gone mainstream, which may be why this recent pullback could represent a deeper and more entrenched bear market. While these margin calls and the subsequent selling of crypto assets to cover them are relatively small as a percentage of total volume, sharp sell-offs have a disproportionate impact on crypto markets and can often cascade. While exchanges don't or sometimes can't disclose what was sold to meet those debt obligations, it is generally recognized that major cryptocurrencies like Bitcoin and Ethereum are leveraged quite frequently. Crypto stands will quickly remind you of the good old days when Bitcoin was $2,000 and how great the run-up has been. That we should be grateful that Bitcoin, for example, is still at $87,000. They will run the same talk track about stored value and decentralization and technology and security, all with the not so subtle undertone of metaphorically sticking it to the man. But the reality is crypto is now mainstream. It has its own dedicated market analysts. There are crypto-only ETFs. Some 401ks now offer exposure, and these tokens are a meaningful portion of the assets under management at every large institutional bank. The question now is whether participation from the larger investor market is what preserves or destroys the speculative value of digital currencies. And no one really knows if this is just another blip on the radar as Bitcoin and others continue a meteoric rise. And in retrospect, we might be clutching our pearls prematurely, joining the hundreds of crypto skeptics that have been proven wrong time and time again. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.